A senior fixed income strategist from Credit Suisse. He's Markovic, and he joins us now from Zurich. Good morning to you, sir. Thanks so much for joining us. So, will this trend of a narrowing spread between corporate bonds and government bonds, especially in the short end of the curve, is that set to continue?
Good morning. Yes, indeed. We believe that this trend, which can be read in credit spreads or also in swap spreads, that this will continue as long as we have a continuing increase in the deficit side and also an increase in the overall debt to GDP levels. So that's not a short-term trend. We have to adjust certainly our spread analysis based on this deteriorating sovereigns and hence deteriorating benchmark yields.
So S&P says the default rate actually among companies is going to drop this year to about 5% from over 10%. Is it the case that companies are simply in much better shape than they were?
Well, in general, I'm not a credit analyst, so I cannot comment on the company or corporate outlook. But what is indeed interesting to see that the dynamic of defaults has come down quite sharply, and that is certainly reflected in the improvement of pricing for new issues on the credit side. So that helps for credits at the same time, as one of your speakers before has said, that the new issue activity from the sovereign side continues to increase and to be very, very massive. And here you simply have an imbalance that can then lead to that what was mentioned before, that some corporates trade tighter or are actually more expensive.
What's your outlook for the U.S. 10-year note?
We expect actually that this deterioration in the sovereign will lead to higher real yields. So the spread between real Fed fund yields and real 10-year yields will increase, but not sharply, not to cause a major sell-off. So we expect about 50 to 70 basis points in the maximum case of the next 12 months. But again, that's very much priced in the forward market, so it will not be enough to trigger a sharp sell-off in the treasury market. It's just going to mean that real yields will increase and the cost for sovereign will increase, not only for the US, but also for the UK and others.
Well, what do you think of PIMCO's comments saying that people should buy Asian bonds rather than Europe and the US?
Well, I think it's a very, very difficult statement here. We have to distinguish, and we are aware that the sovereign situation for emerging market is much better. We expect that the GDP levels to increase, to improve for emerging markets relative to that of developed markets. But at the other end, you have to see where the risk contribution comes from, and I would not see it as a clear cut that only the debt to GDP level improvement in emerging market makes the case for investing there and not in the US. We are compensated for investing in treasuries as much as we are compensated for invested in UK gilts, and therefore it's not straightforward to say only because the sovereign situation is a little bit weaker than in the emerging market that we will have lower total returns here than there.
Right. Now, the IMF's Lipsky said yesterday that advanced economies face, quote, acute challenges in tackling debt. So my question to you is the U.S. in danger of losing its status as the world's benchmark here?
I would say no. And the reason is not because they're deteriorating sovereign solvency ratios, but it's because it's the biggest market in terms of assets. It is the biggest market in the world, and I do not believe that the change only in the sovereign situation with higher debt to GDP levels would lead to losing to be the benchmark for the interest rate market. So I do not expect to see this happening anytime soon.
Okay, but if we do see yields rise on U.S. bonds, then that just makes borrowing money more expensive for the U.S. government. What kind of implications would that have on government debt and the economy?
You're right. If we see the costs increasing for government debt and growth not picking up at the same time, we have a negative snowball effect, which then makes things even worse. At the same time, we have to look how the current interest rate expenses are for the U.S. They have very, very short maturity debt, so therefore they will likely, as long as the Federal Reserve keeps rates low, have actually a lower interest rate expenses going forward. That's not the same for countries that have a higher duration on their debt and which have to refinance with longer maturities. For these kind of countries, and Greece was a perfect example, it is becoming more difficult to actually grow itself out of this debt trap. But for example, for the US, with a very, very low duration, here interest rate expenses should remain solidly around the current growth level, so there should be no snowball effect visible like in other countries.
Markovic, senior fixed income strategist at Credit Suisse, joining us from Zurich. Thanks so much for joining us.